Welcome to the Deep Dive. Today we're taking a closer look at a specific product, the M&L Accelerate 5 Fixed Index Annuity.
Yes, and our information comes primarily from materials provided by Diversified Insurance Brokers about this annuity.
Right. And our goal really is to understand if this might fit the bill for someone looking for, well, conservative growth over the short term, maybe 5 years, while making sure their initial money is safe.
Exactly. Breaking down what it offers, how it works, and who it might genuinely be suitable for. Is it right for that specific kind of near-term, safety-focused strategy?
Okay, let's dive into the basics. It's issued by Midland National Life Insurance Company.
Correct.
And Diversified Insurance Brokers seem to position it for, quote, conservative investors seeking short-term accumulation.
That phrase really sets the stage. It's about balancing market participation, trying to get some growth, but with that core of principal safety.
And it's explicitly a 5-year term product.
Yeah.
Two features mentioned are guaranteed participation, or cap rates, we should unpack that, and protection from market losses.
That 5-year term is quite specific. It suggests it's not necessarily for ultra-long-term planning, but for a defined period. And the balance you mentioned, wanting some growth potential tied to the market.
But without the actual downside risk of being in the market directly. Which brings us to how it works. It's a fixed index annuity.
Precisely. Your returns aren't guaranteed like a CD, but they are linked to the performance of an external market index. You're not buying stocks or bonds yourself.
And this one offers several index choices, gives you some options.
It does. They list things like the S&P MRRC 5% ER, the Fidelity Multi-Factor Yield 5% ER.
Also, the NASDAQ 100 Volatility Control 12%, and an S&P 500 Dynamic Intraday TCA Index. Quite a mix there.
And of course, a simple fixed interest account too, if you want something completely predictable, albeit likely lower potential return.
That variety matters. Depending on the index, like one designed for volatility control versus, say, the standard S&P 500, you might expect different performance patterns.
Right. It allows for a bit of customization within that conservative framework. Now, about those participation rates you mentioned.
Yes, they talk about standard and enhanced rates. And sometimes those enhanced rates might have an extra charge.
That's possible, yes. An optional charge for potentially higher participation in the index gains. But a key point they highlight is these rates, once chosen, are locked for the full 5 years.
That offers predictability, which fits the conservative profile. You know what rules your growth potential is playing by for the term.
And how is that growth actually credited?
They use annual point-to-point crediting with an annual reset.
Okay, so basically, they look at the index performance from the start of the year to the end. If it's up, you get credited interest based on your participation rate or cap up to that limit.
And the annual reset means those gains are locked in each year. If the index drops the next year, it doesn't affect the gains you already secured.
That's a crucial feature for capital preservation. It protects past earnings, and those locked-in gains can then compound.
Plus, the whole thing grows tax-deferred. You don't owe income tax on the earnings until you actually take the money out.
Which can significantly boost the effective return over time compared to a taxable account holding similar assets.
Okay, let's shift to safety and access. We've hit principal protection hard. That's fundamental.
Definitely the main safety net. Your initial premium isn't exposed to market downturns.
But what if you need some cash before the 5 years are up?
Good question. They mention a penalty-free withdrawal provision. Usually after the first contract year, you can take out a portion, often up to 10% of your accumulation value each year without surrender charges.
So it's not completely illiquid, there's some flexibility?
Some, yes, within limits. They also mention a built-in nursing home confinement waiver, which can provide access under specific health circumstances.
And looking further out, what about getting the money out eventually? Payout options.
Yes, standard annuity payout options seem available: lifetime income, payments over a set period, joint and survivor options for couples, things like that.
And the death benefit.
It's typically the full accumulation value paid directly to beneficiaries, importantly, bypassing probate.
That probate avoidance can be a significant benefit for heirs. Okay, so who's this really for? Suitability.
The information suggests it's available across a broad age range, 0 to 85, which is quite wide. Minimum premium is $20,000.
And it works for both qualified money like IRAs or 401k rollovers and non-qualified, just regular savings or investment money.
Right. But the core profile, again, seems to be individuals wanting that market-linked potential, but absolutely prioritizing principal safety and thinking within that specific 5-year time frame.
People perhaps uncomfortable with direct market volatility, especially as they approach or enter retirement.
Diversified Insurance Brokers also notes their role is helping clients assess if such a product actually matches their individual goals and risk tolerance, which is key.
Absolutely. So wrapping up the key takeaways. The M&L Accelerate 5, based on this info, offers principal protection as its core promise.
It provides potential for growth linked to various market indexes with locked-in rates for 5 years and annual reset.
It offers tax-deferred growth and provides some liquidity through penalty-free withdrawals and other features like waivers and payout options.
Fundamentally, it's a choice for safety and moderate, predictable growth potential over a defined period, sacrificing the higher potential upside and associated risk of direct market investing.
So the final thought for listeners is this. Considering your own financial situation, your retirement horizon, and how much risk you're truly comfortable with, how might a structured product like this fit or not fit into your overall plan?
And what questions does this raise that you want to discuss further with a financial professional who understands your complete picture?
Good points to ponder. Thanks for joining us for this deep dive.